My channel. I'm Doris and I'm here to share with you about my stock account update and also today's market. Today my account earned $4,000 in total. The Dow Jones fell more than 600 points as focused on inflation and Fed policy. 3. December producer price index and the Bank of Japan's interest rate decision. So first let's take a look at my account. Right now, the total asset of my account is $88,083.69. Today, it gained 4,080 cents, which is 4.76%, including the aftermarket price. Today, for the market period, it rose. The SQQ, which I had 1,300 shares of, rose 3.77% to $47.34, and DRV, which I have 500 shares of, rose 4.63% to $45.38. It means that the market, because both of the ETF are bear ETF, which means that the market must be doing bad today. Sorry. Dow Jones Industrial Average decreased by 1.81% to $33,296.96. Nasdaq Composite decreased by 1.24% to 10,957.01. S&P 500 decreased by 1.56% to 3,928.86. Today, all of the industries showed a negative gain. Few particular industries that decreased the most include beverages, household, discount stores, utilities, and insurance. And then we're going to talk about why. US stocks closed lower on Wednesday, with the Dow Jones down more than 600 points and the S&P 500 hitting its biggest one-day drop in a month. Economic data once again showed that U.S. inflation remains high, but many have begun to peak. The Fed's Mr.Bullard's comments raised investors' concern that the agency could continue aggressively raising interest rates. News of Microsoft mass layoff has frustrated market sentiment. U.S. stocks opened higher and lower on Wednesday, eventually closing sharply lower. BMO Wealth Management Chief Investment Strategist Yuma attributed the reversal to a combination of insecurity and profit-taking. He said, "We have had a strong start to the year, but now we're in a tight earnings season, with recent data, including today's retail sales and yesterday's New York State manufacturing survey, being generally weak. Moreover, the Fed meeting on February 1st is looming. Now, investors don't have much reason to be aggressive." All of these factors suggest that caution needs to be exercised in the short term. Market sentiment was hurt by a dovish Fed official speaking in support of a continued rate rise. St. Louis Fed President James Bullard said on Wednesday that the United States must raise interest rates further to ensure that inflationary pressures subside. Bullard said, U.S. interest rates are almost entered a range that we could call a restrictive level, but we're not fully there. Officials want to ensure that inflation falls steadily to its 2% target. We don't want to abandon that. And as the anti-inflation process unfolds, the policy must remain tight in 2023. Analysts note that despite the cooling, the inflation data and weak retail sales, the Fed still needs to act quickly to the benchmark interest above 5%, raising concerns that the Fed could raise rates by another 50 basis points. Traders have been worried that the aggressive interest rate hikes in the U.S. could lead to a recession. Microsoft also restrained market sentiment by announcing some 10,000 jobs cut. December PPI. Investors are also watching for the latest PPI, which fell 0.5% in December, while economists on average expected to fall 0.1%. The PPI index, a measure of corporate input cost, is often used as a leading indicator of future inflation. The PPI suggests that inflation in the U.S. may have begun to slow. After the data, the benchmark 10-year Treasury yield fell 0.44% to 3.439%. The yield on the 30-year note fell to 3.573%. In addition, U.S. retail sales fell 1.1% in December from the previous month, the biggest drop since December 2021. On Wednesday's earnings report, United's most recent quarter announcement was driven by strong growth in travel demand that beat market expectations. Moderna says its vaccine against respiratory syncytial virus can prevent such infections in the elderly. Recent earnings result from several large banks show that even companies in the same industry will move differently. Goldman's investment banking and asset management division saw lower revenues, dragging down its results. Morgan Stanley's results were boosted by strong revenue growth in its wealth management division. SoFi Solutions said, "It is a critical earnings season to see if companies can survive the storm or how long can they survive." He said, "I still think we're in the range where the market tends to rebound on bad news, because the bad news means the Fed's pace will slow, pause, or even turn, and the Fed will end the cycle sooner than they say. I think we focus too focused on the Fed at this point. It's not just about the Fed." Producer prices fell 0.5% last month, the biggest drop since April 2020, and up 6.2% year-on-year. Labor Department data showed on Wednesday the median forecast for economist survey was 0.1 month-on-month decline and a 6.8% rise from December 2021. The core PPI, excluding volatile food and energy components, rose 0.1% for that month, up 5.5% for a year earlier. After the December PPI data, analysts said the future showed that the Fed's inflation test is far from over. The drop in PPI in December was driven by a slump in commodity prices, particularly energy and food prices. Consumer price data released last week also showed that price pressures are easing. As supply chains normalize and the global demand for goods cools, supply and demand are becoming more balanced. Still, the Fed's mandate of dealing with inflation is far from over. The recent weakness of the dollar has made U.S.-produced goods more competitive. Labor market strength, combined with resilient consumer demand for services, could keep inflation above the Fed's target. Citi CEO Jim Fraser said recently that the Fed could slow its rate hikes in the late spring or early summer. He said Citi expects the U.S. economy to see a mild recession in the second half of the year. After months of relentless rate hikes, the Fed hinted in December that it will slow the pace of Fed tightening increases, with the full impact infiltrating the economy. However, Fed Chairman Colin Powell recently warned the market against overdue optimism and reiterated that central banks need to tighten inflation controls. Separate data shows U.S. retail sales fell 1.1% in December from the previous month, the biggest drop since December 2021. Retail sales are the main backbone of the economy, and the data shows a weak economy. Bank of Japan. The yen weakened after the Bank of Japan decided to maintain key interest rates and yield curve control to policies, while Japanese stocks rose sharply. The Nikkei 225 index rose 2.5%, its biggest gain since November. The boss decision means the central bank could face further battles with Japanese bond bears. The wrangling is likely to take longer time without a policy meeting in February. The Bulge unexpectedly doubled its extended target yield range in December from 0.25% to 0.5% to extend the life of the YYC. It fired, however, which investors saw as a precursor to the Bulge's policy shift and triggered a bond sell-off. That's all I have for today. Thank you for listening. Don't forget to subscribe and like. See you next episode.